Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most popular and versatile technical indicators out there, the Bollinger Bands. Whether you're a seasoned trader or just starting your journey, understanding how to use Bollinger Bands can seriously level up your market analysis. So, grab a coffee, get comfortable, and let's unravel the secrets of this powerful tool. First things first, what exactly are Bollinger Bands? Developed by the legendary technical analyst John Bollinger in the 1980s, they consist of 3 lines plotted on a price chart. The middle line is a simple moving average, usually set to a 20 period. The upper and lower bands are then plotted to standard deviations away from this middle band. Now, I know standard deviation sounds a bit like a scary math term, but don't worry. All it really means is that the bands measure volatility. When the market is quiet and prices are stable, the bands will contract or get closer together. When the market is volatile and prices are swinging wildly, the bands will expand, moving further apart. Think of them as a dynamic channel that adapts to the market's mood. So, the big question is, how do we actually use this? One of the most common strategies is what's known as trading the bands. The core idea here is that price tends to return to the middle. The upper and lower bands act like dynamic support and resistance levels. When the price touches the upper band, it might be considered overbought, suggesting that it's getting a bit expensive and could be due for a pullback. Conversely, when the price touches the lower band, it might be considered oversold, meaning it's relatively cheap and could be poised for a bounce. So, a simple strategy might be to look for potential selling opportunities near the upper band and buying opportunities near the lower band. But, and this is a huge but, never use this in isolation. A touch of the band is not a signal by itself. It's a point of interest where you should look for other confirming signals, like candlestick patterns or other indicators. Now, let's talk about one of the most powerful signals Bollinger Bands can give us, the squeeze. This is my personal favorite. The squeeze happens when the bands get very narrow and contract tightly around the price. Remember what we said earlier. Narrow bands mean low volatility. This period of calm is often the calm before the storm. A squeeze signals that a period of low volatility is likely to be followed by a period of high volatility, a big price move. The challenge, of course, is figuring out which direction that move will be. Will it break out to the upside or the downside? To solve this puzzle, traders often look for the price to break and close decisively outside of one of the bands after a squeeze. A close above the upper band could signal the start of a strong uptrend, while a close below the lower band might signal the beginning of a downtrend. The squeeze is fantastic for identifying potential breakout trades. Another key concept is what's called walking the band. This happens during strong, established trends. In a powerful uptrend, you'll often see the price repeatedly touching or walking up the upper Bollinger Band. It will flirt with the upper band, pull back slightly towards the middle band, and then rally back up to the upper band again. In this scenario, touching the upper band is not a sell signal. It's actually a sign of strength. The trend is so strong that it's constantly pushing the boundaries of expected volatility. Similarly, in a strong downtrend, the price will walk down the lower band. Trying to buy every time the price touches the lower band in this situation would be like trying to catch a falling knife. So, when you see the price walking the band, it's a confirmation of the trend's strength, and it might be better to trade with the trend rather than against it. Let's put this into a more practical context. Imagine you're looking at a stock chart. You notice the Bollinger Bands have been getting progressively tighter over the past few days. You've identified a squeeze. You're now on high alert, waiting for a breakout. Suddenly, you see a large green candle that closes firmly above the upper Bollinger Band. This could be your entry signal for a long position. You might place your stop loss just below the middle band or below a recent swing low to manage your risk. As the price starts moving up, you notice it's consistently touching the upper band. It's walking the band. This gives you the confidence to hold onto your trade. possibly trailing your stop loss up to lock in profits, rather than selling too early. This is how you can combine the squeeze and walking the band to manage a trade from start to finish. Now, let's talk about customizing the settings. The default setting is a 20-period simple moving average with 2 standard deviations. This works well for most situations, especially for swing trading on daily charts. However, there's no magic number. If you're a short-term day trader, you might want to use a shorter period, like a 10-period moving average with 1.9 standard deviations, to make the bands more sensitive to recent price action. If you're a long-term investor, you might prefer a longer period, like a 50-period moving average, to smooth out the noise and focus on the major trend. The key is to experiment and backtest. See what settings work best for the specific asset you're trading and your personal trading style. Don't be afraid to tweak the parameters on a demo account until you find what feels right for you. One common mistake traders make is relying solely on Bollinger Bands. I can't stress this enough. No single indicator is a holy grail. Bollinger Bands are a tool for measuring volatility and identifying potential overbought or oversold levels, but they don't predict the future. They should always be used as part of a comprehensive trading plan. For example, combine them with a momentum indicator like the RSI, or Relative Strength Index. If the price touches the upper Bollinger Band and the RSI is also showing a bearish divergence, meaning price is making a new high, but RSI isn't, that's a much stronger signal to consider a short position than just the band touch alone. Or, use them with volume analysis. A breakout from a squeeze on high volume is far more convincing than one on low volume. Always look for confluence, where multiple indicators are all telling you the same story. To recap, we've covered the 3 main ways to use Bollinger Bands. First, as dynamic overbought and oversold levels, looking for potential reversals when price touches the outer bands, but always seeking confirmation. Second, identifying the squeeze, which signals a period of low volatility that is likely to be followed by a significant price move. And third, recognizing when the price is walking the band as a sign of a strong, healthy trend. Remember to also consider adjusting the settings to fit your time frame, and to always use Bollinger Bands in conjunction with other tools and a solid risk management strategy. They are a fantastic addition to any trader's toolbox, providing a unique perspective on volatility and price action that can help you spot opportunities you might otherwise miss. I hope this detailed walkthrough has demystified Bollinger Bands for you. They really are a wonderfully intuitive tool once you get the hang of them. The best way to learn is to apply them. Go ahead and add them to your charts, watch how they interact with the price, and start identifying the patterns we've discussed today. Thank you so much for tuning in. If you found this video helpful and want to learn more about trading strategies and technical analysis, make sure to hit that like button and definitely subscribe to the channel so you don't miss our future videos. Got any questions or your own tips for using Bollinger Bands? Drop them in the comments below. I love hearing from you all. Until next time, trade safe and trade smart.